Hello everyone, my name is Gaurav. I am an elite popular investor on eToro. I have about 700 copiers and around $1 million in assets under copy. Last week I was in Abu Dhabi attending the eToro's PI summit that was combined with the Abu Dhabi Finance Week. That was an amazing experience. And now I'm back from the desert to my home in Germany, which is, as you can see around me, cold and icy, slushy winter wonderland. Yesterday there was a lot of snow around me, and now it's only some few traces left of it. It was looking really beautiful yesterday, and I hope I will show you next time when it snows again. So for a while now I've been promising my copiers to make videos, and I have failed. And that's not because of lack of commitment. I tried making a few videos, but I had to scrap them away because I was too conscious about the way I looked and the way I sounded. But this time I've made up my mind to just let it go. I'm gonna publish this video however it comes out, and I hope you will like it. I don't have a script for this one, and I just want to briefly introduce myself, talk about my strategy a little bit, and I hope that this is going to add value to your investment approach. So a little bit about me. I am a software engineer. I grew up in India. I came to Germany in 2012 to finish my studies. I did a master's in computer science from Technical University of Munich, which is among the top 10 universities in the world. Since then I've worked across the technology industry in a number of various technologies, and I have built a strong perspective and intuition about the trends in the software industry. In terms of investment, I focus primarily on the US tech stocks because that's what I understand well. I diversify within that segment, as I will talk later about. Now, I'm a very analytical person, and even before I started investing in 2019, I read up a lot of books, and I had formulated for myself already a rough investment strategy. The first book that I read was Intelligent Investor by Benjamin Graham. Now, this is a very popular book. A lot of people read it, but for me, I took the concepts from this book to heart. The main thing I loved about this book was the simplicity. It talks about how a strategy must be simple and reasonable, and that the strength or the key to success of an investment approach is not the strategy but the execution. So I knew I had to focus on execution, and to do that I came up with a set of core guiding principles from which I derived the action plans. The first guiding principle for me is do not try to time the market. So the action plan I derive from that is that every time I open a new position, I do not invest all of my money at once in that position. Instead, I buy in small chunks and dollar cost average my way to building a position in this stock. The next one is have conviction in your ideas, but do not get overconfident. Now, you might find yourself in a situation where you believe truly in a company or a thesis, but you want to make sure that you do not put too much risks on that one thesis. This is really important. And the action plan that I derive from this is that I have a max allocation for each position. The biggest position in my portfolio today is 5%, and I intend to keep it around this 5 to 6% range. The next principle for me is do not panic. And this kind of flows from the previous one. If you've managed your risks, if you've limited your exposure to individual stocks and individual theses, you are not prone to act in fear. You will not panic. And then the fourth one is introspect. And this is really important. A lot of investors have this misconception that they only make a loss when they sell in red. Now, that's a big fallacy. As investors, we are not trying to get 100% of our trade decisions right. We are only trying to get a majority of our trade decisions right. And by that definition, we're gonna make mistakes. And so I make it a point to revisit my thesis, introspect my trade decisions, and wherever I make a mistake, I accept those mistakes, I take the loss, and I put that money to better use somewhere else. This, I think, is a very important step which a lot of investors miss. The other thing that I want to talk about is how do you judge the performance of a portfolio. Now, you've probably heard people say that the benchmark for my portfolio is the S&P. Now, let's try to understand what that means. What that means basically is that your portfolio is designed to beat the S&P. And why is S&P a popular chosen benchmark? Because S&P is considered to be a well diversified, low risk, passive investment strategy. So if you don't want to invest too much of your time and effort, you could just dollar cost average on the S&P. But most active investors believe that they can beat the S&P. But when you say your benchmark is the S&P, you should be able to explain how you intend to beat it. For me as well, the benchmark is S&P, and since I invest in US tech stocks, I think it's only fair to compare my performance against the Nasdaq. Now, Nasdaq in itself is not a very popular passive investment asset because it's mostly comprised of US tech stocks, which are prone to bubbles and are highly volatile. So it's not really low risk. But with my portfolio, I intend to manage the risks and yet try to beat the Nasdaq. As prudent investors, you must question every statement I make. And so let me explain how I intend to beat the Nasdaq. So when the Nasdaq goes up 20%, it's not that all the 100 companies in the Nasdaq index are going up 20%. It's only a few outperformers that grow 30-40%, and most of the majority are staying stagnant or even declining. And so my goal is to find these top performers in the Nasdaq, and I invest around 60% of my funds in these companies from the Nasdaq which will outperform the market. I pick these stocks based on fundamentals, but I also look at a lot of other aspects such as good leadership, growth plan, product reviews, feedback, how they're hiring and how they're able to retain their employees, and a lot of other factors. The next 30% of my funds go to mid-cap companies that have the potential of replacing a company in the Nasdaq in the coming 5 years. Now, often with these high growth mid-cap companies, it's not enough to just look at fundamentals because often they have very high PE ratios. And so I also look at the other aspects I mentioned before, like leadership, growth plan, and I decide which companies have the potential of returning multifold gains and possibly replacing a company in the Nasdaq. The remaining 10% of my funds are invested in moonshots, which have a high risk and a high growth potential. These are companies like Neo, who have a proven product, if not yet a proven business plan. And it's really important to see how they intend to achieve their growth and how well they've been executing on it in the past few quarters. And this is how I intend to beat the Nasdaq. Now, I spoke about diversification within the technology sector, and let me explain this because diversification is really, really important. In the past, I tried to diversify across different market segments, and I realized that it was really hard to keep a track of all of my investments. I was spreading myself too thin. But then I realized it's really not important to diversify across so many market segments. You can focus on what you understand and find diversification opportunities within that segment. Now, for example, I believe in AI. Now, Nvidia and Microsoft are the obvious winners in this area for now. But we are not in the game of horse race betting. When there is disruption in the market, there is often more than one winners. So when Nvidia wins, other competitors like AMD, Qualcomm and Intel, they refocus their energy and try to take some of the profit margins from Nvidia, and eventually they also win. When Microsoft wins, competitors like Google and Adobe also win. Companies will find new ways to apply AI to their areas of strength and find new growth opportunities. I've seen the same trend play out across multiple business domains like consumer electronics, electric vehicles, and financial services. Now, in the last few minutes, I've been able to give you everything about my strategy. As you can imagine, this is a very simple and reliable strategy, and anyone can come up with a strategy like this. But as I said, the key to success is not just the strategy, but the execution of the strategy. This investment approach has been giving me very good results. My portfolio is up 42% year to date, which is trailing slightly behind Nasdaq and beating the S&P very comfortably. Now that's all I had for this video. I hope you found some value in my content and you would consider liking and sharing this video. You will find the link to my eToro profile page in the description below, and you might consider following or copying me on eToro. If you are not yet on eToro, you might also consider using my referral link to join eToro. That would help me out immensely. In closing, I want to remind you once again, keep your investment strategies simple and focus on execution. Thank you so much for listening to me. I hope to keep this conversation going. Bye bye.